Today, I want to break down exactly what the inflation numbers are saying to us, what it could mean for interest rates, and how you as a home buyer or investor can position yourself to take advantage in a time just like this. But before we keep going, my name is David, I'm a mortgage broker, and I work with hundreds of home buyers and investors every single year to get themselves into the property market. So if you're interested in what my thoughts are, please subscribe to the channel and like the video. It really helps the channel grow. So first things first, we need to recap exactly what inflation is. To put it simply, inflation is how fast prices are actually rising, and the RBA loves to keep that between a 2 to 3% band. When inflation is high, that's because we're spending a little bit too fast. Businesses need to raise their prices because demand is outweighing that supply, which is simple economics. When inflation starts to cool, that's because we have all constricted our budgets, we don't have as much money flowing around in the economy, and that's when generally we might see rates actually decrease to encourage us to spend more. It's really all in an effort to balance up the economy because rates are one of those levers that we can pull to either stimulate the markets or constrict us so we spend that little bit less. One of the more important things that not many people talk about is that not all inflation data is made equal. First, you're going to see a lot of the articles talking about the headline inflation number, where actually the RBA only really cares about the trimmed mean inflation. So, headline inflation is taking all of the goods and services prices across all of the categories and then seeing how fast the prices rise over all of these categories over time. The trimmed mean inflation numbers, which is what we all care about, is actually the middle 70% where we strip out the most volatile price movers, making sure we look at a long-term stable view of how prices are actually moving. We do this so we can strip out things like one-off increases in things like school fees, which generally happens once a year and can really skew data if we don't strip it out. Now, looking at the latest inflation data that was released on the 28th of January 2026, headline inflation is up to 3.8% over the year to December 2025. Which is up from 3.4 in November. This tells us that inflation isn't really moving in a straight line, it's not really moving down, it's a little bit bumpy. Underlying inflation, or the trimmed mean inflation, which is what we all care about, is actually sitting at 3.3%, which is up from 3.2% in November, still slightly above the RBA's target band. So it didn't go straight along with 3.2%, but 3.3, not a huge jump, but it is still an increase. However, when it comes to moving interest rates, the RBA is also looking at the unemployment numbers. Right now, unemployment is relatively tight, but interest rates don't work instantly when it comes to the unemployment figures. It's actually a lagging effect. When you really think about it, if rates go up, businesses then get put under pressure because people are spending less. When businesses are under pressure, they start hiring a little bit more slowly. And when they hire a little bit more slowly, that means inevitably the unemployment is going to increase. The fact of the matter is, if unemployment has spiked, that means the damage is already done from raising interest rates, which is why I think the RBA is going to be incredibly cautious because they want inflation to stabilize and they don't want to break the job market. But when we look at all of these articles, it's really going to center all around property prices, but there is another player in the game that can help us with managing property prices right now, and that's APRA. APRA is the governing body that essentially maps out all the rules and all the credit requirements that the banks have to be able to lend money to the average borrower. Right now, trust lending is coming under a lot of scrutiny by APRA, as well as high DTI lendings, or debt to income ratio lending, which means they're going to try to limit property investors and how much property they can actually acquire, which is another lever they can sort of try and pull to cap these property prices raising too quickly. And the thing about APRA is they move incredibly quickly, they move faster than the RBA, and they move faster than the average property buyer. Back in October, you would have seen everywhere that the home guarantee scheme was expanded. What this did was lower the deposit barrier to getting into your first home. If you've watched any of my videos before, you would have both income and you would have both security to be able to go ahead and get your first home or a property in general. What the government did with the home guarantee scheme is say, well, everyone is now eligible to go in with a low deposit. Previously, it was capped at a certain income, only aimed at particular people. However, now it is just increased to everyone who hasn't bought a property before. Doesn't matter what you earn, you can earn hundreds of thousands of dollars a year. You can get in with a 5% deposit. So then what that actually did was pull all of the demand from the future into the present and spike home prices at the end of 2025. And this is now the position we find ourselves in. And that's why these rate decisions need to be incredibly careful. Inflation is easing, but it's still above the target just by that little bit. Unemployment, incredibly tight, but it's at risk of rising with a delay, and we're not really sure if that's going to happen. Then we also have credit that is getting constrained by APRA, and we need to wait to see what those effects are like on house prices. But these property prices have been influenced by government policy and the home guarantee scheme. Thinking about all of this is pulling my head in all different directions, which is why I need to even read it off the screen to get that out coherently. But before we talk about what I actually think the inflation numbers are going to mean for the next RBA meeting, we need to look at what the banks are doing. So all of the banks have started increasing their fixed rates. I've been seeing this for the past 3 to 4 weeks. Slowly, emails will come through and fixed rates are increasing. What the banks are doing here is essentially hedging their bets. When we had all of the sentiment that rates were going to continue to drop, banks were cutting their fixed rates like crazy to dangle the carrot in front of borrowers and get them to fix at a slightly lower level to their variable rates. Now that the sentiment is turning and people are talking about a hold or even an interest rate rise next week, they have started increasing their interest rates to hedge their bets. They acted too quickly the first time, and I think they're acting too quickly again. This is because what they might have is a lot of people on their books that have locked in at that lower rate. They don't actually know what's going to happen. None of them actually know what's going to happen. So they're saying, hey, let's increase our fixed rates so we don't get too many people sitting at low rates just in case we get these rates going up in the next 2 to 3 meetings. So what is Michelle Bullock and the RBA board going to do about the data that has just come out? Well, I think it's going to be an interest rate hold in February. If we get some more poor data and we don't see it trending down just that little bit, we're probably going to get a rise in May. It's definitely not a victory, that's for sure, but I think it's progress, or at least we're still painting a picture and seeing where we're going to go with this. I don't think we have enough information to actually put rates up next week. I could be incredibly wrong. This could outdate very, very quickly, but I don't think rates are going up in February 2026. But if you're an investor or a home buyer, what should you be doing in a time like this? These are my top 6 recommendations for you right now. First, it's understand the environment that you are in. The media is going to paint the picture of doom and gloom, but just understand where you're sitting, what you need to do, and really just assess your own personal situation and not worry too much about the macro environment right now when you're looking at what you want to do with property. Next, it's stop trying to time the rate cuts. If you wait for rates to fall and then you're going to act, chances are you're already going to be too late, because by the time the sentiment runs through the economy and says, hey, we actually think we're going to reduce interest rates, and then they go ahead and reduce interest rates, all of the opportunity has already been sucked up by the people who understood the market and that property is a long-term game. Number 3 is that I want you to shift yourself from prediction to preparation. In environments like this, successful investors and home buyers don't predict what's going to happen. They understand that property is a long-term game and they're going to prepare themselves the best way that they can, get their cash buffers in place, release the equity where they can, go to inspections where no one else is going to inspections, and buying property in times where people are a little bit fearful. This then follows on to number 4, which is use the hesitation of everyone around you to your advantage. Naturally, the open homes are going to start thinning out with participants, and if you're in there, you could get yourself a pretty good deal, whether it's on your first home or your investment. And then again, it feels like I'm saying the same thing over and over again. It's going to be keeping a long-term frame. Just remember that property is a long-term game. If you're getting in this for a short-term flip, you are going to be sorely disappointed. This isn't going to be the right market for you. You need to be able to buy property, you need to be able to hold that property, and it needs to fit your long-term plan as well. And number 6, this is the one I'm going to leave you with. It's having the right mindset right now. The goal in this type of market is not to be early, it's just to be ready. You need to be financially resilient, you need to be clear on your strategy and your goals, and you need to be incredibly patient. Do not act with emotion, because when you act with emotion, you generally make wrong decisions.